Today, I wanted to talk about what's called our universal life policies. And with the universal life policies, the way that those ones work, if you're not familiar with them or what a universal life policy is, I'll give you the pitch on how you can explain it to your client so that way they can understand it. Sometimes what we see with our clients is you can talk above them from the perspective of we're such experts and we use industry terms, and the industry terms that we use can confuse our clients, right? So little things like saying cost of insurance, right? That could hurt our clients and confuse the clients, whereas that's the last thing we want to do, right? We don't want to confuse clients because confused people don't buy. And that's a very important thing for us. So that's why I needed to break this down from an agent's perspective, right? So for us as agents, we can talk to each other at a higher level than from agent to agent than we can for a client. Okay. So if you were to go ahead and Google universal life policy, you're probably going to get a definition here that might confuse a lot of people. So I always like to go to Investopedia, and I always like to look stuff up over there, right? So you can kind of read about it and see, right? So universal, the way that I kind of explain it to our clients is we have a combination here, right, of term and whole life. Okay. It may not last your whole life, kind of like term doesn't last your whole life. So you're kind of taking a gamble there. Term is gambling, especially for our senior market, right? 65, 70 years old, like term might not be the best option. So whenever we're looking at that and explaining how term works, right? Term is just short for terminate, right? And it's temporary insurance. So it lasts for a certain period of time and then it just terminates, it ends. Okay. And then once that period of time is up, you have nothing else. So what we need to do at that point in time is find something for you new. And that's what most people do is they look at this other type plan or the other type of insurance, which is called whole life insurance. And whole life insurance is really simple, right? Basically, the way it works is you pay the same amount. So no matter how old you get or how sick you get, the amount you pay per month doesn't go up. The amount of insurance you got doesn't go down, and it lasts your whole life. So that's an amazing thing for our clients, right? Really, really simple and straightforward. So I always want to tell our clients that and I never mention universal life to our clients because that goes with the same saying, right? Confused people don't buy. And the reason why is because it's very confusing, right? It can be confusing for insurance agents to look at. And that's the downside of it. So what I do is I always will draw stuff out for our clients. And I'll show you some graphics of kind of how I actually draw it out so you guys can see it. And let me, and then what I want to do in a second too, is I want to screen share so you guys can see a spreadsheet that I kind of built for it. So, and it's really straightforward. It's not the spreadsheet will kind of explain everything. And this is actually what you'll be seeing when you're sitting down with a client. You'll actually be seeing this and inside of their policy. So you're going to need to know what you need to look at when you're inside of a policy, okay? Or when you're inside of their policy, you got to say, hey, what am I looking at? This is like really, really confusing. So what I do is I go ahead over here. Let me screen share so y'all can see what I'm looking at. Give me 1 second. I will screen share. Screen 2, good. All right. So now over here, I have, let me move this out of the way for my printer. All right, cool. All right. So now over here, what I have is I have this little chart. Okay. And this is what you'll generally see inside of a client's policy. Okay. So inside their policy, what you're going to see is you'll see over there the premium, and then you have the center column, which is called cost of insurance. Okay. Then you got cash value. Okay. And what we're talking about primarily here is what's called IULs. That's what you're going to see out in the field. Variable universal life is different. We'll get into that in just a moment. Okay. So IULs, index universal life policy. So a client pays their premium in this left-hand column over here, and every single month they pay that premium to the insurance company. All right. And that premium does not change until a certain point in time. Premium, and this next column that we have here is what's called cost of insurance. Cost of insurance, like what does that mean? Right? So cost of insurance is a growing number based on the client's age, and that changes every single year. Okay. So that's a number that's going to increase. So as far as the cost of insurance goes, we know that this number is going up, and that's essentially based on their age, right? That's all that it's based on. Now, when we go to the next column over here, we see cash value. Okay. So cash value, which is kind of what I always explain, it makes it between a hybrid and a term product. A bad universal life policy ain't going to last your whole entire life. And we'll get into that in just a moment. So when we're looking at this third column that we have here in the policy, we see cash value. All right. Well, what is cash value? Okay. Cash value is when the client makes a premium payment. Okay. Like, how do you solve for cash value in this equation? When the client makes a premium payment in the column all the way to the left, it's premium minus cost of insurance equals cash value. Okay. So it's a horseshoe. All right. In the beginning, the premium is $150. The cost of insurance in year one is $0. So for us, that equates to cash value being $150. And as you can see over here, we're going to have our cash value, and this is the difference between it, right? So cash value over time is going to continue to grow. All right. It's going to grow until we hit our peak. And the peak that we're going to hit over there is going to be when we hit 0 in terms of dollar amount. But let me walk through this, and I want to pull up this chart that I can show you guys real quick. Let me go into my Dropbox and pull it on up. Give me 1 second. And let me pull up this chart. So I want you guys to see this so you can see what I'm talking about. And if you just like always, if you guys have questions, just go ahead and drop it in the group chat so I can see it. All right. So here we go. Hopefully this is it. There we go. Okay, cool. So this is literally what I draw when I'm with the clients. Okay. So you start off with $0 of cash value, right? CV, right over here at the bottom. And then what happens is your cash value grows, right? So our cash value is going to grow over time because the cost of insurance, right, is lower than the premium. Okay. So 150 minus whatever that number is right here, $35. Our cash value has now grown by $115 for that year. Okay. And it's going to be a rolling number, right? So it's going to be equal sum, and then it'll be this number plus this number right here. Okay. And then, yeah. All right. Let me just go ahead and do that real quick. So that way we have the whole entire thing here and we can see it. All right. So now over here, you see, let's solve that one. There we go. Cool. All right. So now you see over here in this far column that we have our total cash value. Okay. And that's like what's accumulating. So we have that 150 minus 0 equals 150 in cash value. And now let's look at this chart over here. I'm going to put them right next to each other side by side. So everyone should be able to see this. And if you're on a computer, it's obviously going to be easier to see it than if you are on your phone. So let me just kind of size it well for people that are on their phone. So hopefully you can see it. Hey, Scott, you're on your phone. Can you give me a thumbs up if you can see that all right?
Yes, I can see it. As long as you make sure you turn to the side.
Yeah, to turn yours to the side. All right. If you're on your cell phone, turn to the side. Thanks, Scott. All right. So when I'm looking at this now, and you see this in year one over here, this column premium is 150. That's starting off at the bottom right over here. Okay. Where the cash value is 0. So as that cash value, this is year one. Year one, there's no cash value. As the cash value begins to accumulate, our cash value is growing. So let's say the client is 40 years old, they get the policy, and then the cash value is growing. Let's say this peak over here is 55 years old and they start to send in a lead card. So when they start to send in a lead card, they're no longer growing in cash value. okay? Because the premium is equal to the cost of insurance. So now that the premium is equal to the cost of insurance, their cash value is not growing. Since the cash value isn't growing anymore, the cash value is going to do what? It's going to start to decrease, okay? So what we see over here is since the cost of insurance is increasing, our cash value is decreasing. Why does the cash value decrease? It's a great question. When there's no more cash value, your new premium payment is the cost of insurance. Now let's look at this column over here before I pull that back up. Let's look at this column. Cost of insurance is $310 in this year in the bottom right over here. Okay. $310. How many of y'all do you know for our final expense clients that can afford $310 a month? Not many. Now, if you can afford 150, that's a pretty good size premium. Hey, we write an app, we get a nice size app, we can afford that. The downside here is that once that cash value is gone, they got to now pay this premium amount. But what happens to the cost of insurance? It's continuing to go up. So since that cost of insurance is continuing to go up, right, every single year, when the client gets to be, they took it out when they were 40, right? We're down over here, 23. So 23 and 40, 63 years old. Their new premium payment when all that cash value is gone is $510. That becomes unaffordable, right? Premium means nothing now, right? There's no more cash value. There's no more cash value to offset the cost of the insurance. No more cash value to offset the cost of insurance. So, why did cash value in the last column go down in year 3? Cash values, it's going to start to decrease, or the formula is wrong. Yeah, it's fine. But either way, what we see over here, once we get to the end of the horseshoe, all the way down at that bottom, the new premium is our COI, which is cost of insurance, because you're going to see COI on there, right? It generally doesn't say cost of insurance. It says COI. And in some policies, it might say cost of insurance, which is fine. So I want y'all to understand how this stuff works at its core. And then when I'm done explaining this to a client as best I can, right, I then say to them, that's really confusing. And that's why most people go with whole life insurance, because it's really simple. And the way that whole life works is you just pay a premium payment. Your insurance, if it's $20,000, that stays the same. The $20,000 is $20,000. And the $150 a month is $150 a month. It never changes. Okay, that's it. It's as simple as it gets. It's safety and security. Remember, we sell certainty. When you pass away, okay, when you pass away, that $20,000 goes to your family. Now, what happens here with this universal life policy, Miss Mary, okay, is once you get to that $510 a month in premium, you can't afford it anymore. You have to cancel it, right? And you don't want insurance just to cancel it. So these policies were great, okay, but since we're in 2022 and you got this in 1999, 23 years ago, interest rates have changed. And since interest rates have changed, that's how they forecast these products. So let's explain how that operates. Okay. So we take the money inside. So a universal life policy is basically set up for, and you're supposed to what's called overfund a universal life policy, meaning this doesn't happen, right? We never want this to happen in a policy where there's no more cash value and the policy basically implodes. A lot of policies that we see from the 80s and the 90s implode on themselves simply because interest rates at certain points in time were higher. So let's say, for example, we were in a high interest rate environment, which we're going back towards right now, okay? And we had an interest rate environment of 10% or 15% interest. What does that mean for these policies? Well, as we know, the policies with their cash value is going to be forecasted based off of a percentage, right? So that percentage is going to say, hey, we can earn 5% on this policy, guarantee we're going to get 5% on this policy, and we can forecast this policy to lasting till age 95, right? Based on a 5% interest rate. hey, if you got an IUL at a 5% interest rate right now, and we're looking at interest rates with banks right now, what are they at if you're getting a mortgage right now? If you were to Google it, I don't know what it is, 5.25, 5.5, maybe 6, right? Depending on your credit. No idea. In that ballpark is what I'd guess, right? And that's going up from 2.75% or in that ballpark, 3.25 that it once was. So that means that those IUL policies are pretty solid. But if you were telling me, if you forecasted a policy and you're telling me every year you're going to forecast this policy off of a 10% interest rate, good luck. You're not going to get a 10% interest rate every single year. It's very, very difficult, especially when money became so cheap. When money was cheap and the Fed was saying, hey, 25 basis points, 0.25, 0.5, that's what we're lending money for. You're going to get a 10% return on that money. Well, when that happens, the cash value doesn't grow and doesn't accumulate as much. Okay. So the cash value that was forecasted at a higher interest rate means that this policy is going to deplete itself sooner than later. Right. So we want to do with the universal life policy what's called overfund it. Okay. So overfunding a universal life policy, essentially what that means is we want to take this premium over here. Okay. And instead of having this premium at 150, we want to pay 250 into it. Okay. Let's go with $250. Let's get a much healthier policy here. So let's take 250 here. And let's see what the numbers actually look like. So when you look over here, right, the premium being much higher means that we are doing what's called overfunding a universal life policy. Okay. So you might have a client that you're sitting down with, okay, that has a policy that they've been overfunding. And that's great. Their cash value is rich. The policy looks fantastic on paper, right? Or you could sit down with a client. You can tell them, hey, Miss Mary, all you got to do with this policy is probably pay an extra $25 a month on it, and it should last until you're 85 years old, right? Then at that point, when you're 85, I don't know what to tell you. But if you sit down with a client whose cash value is zero, right? And you ask them, hey, has your premium ever gone up with this? And they say yes. Oh, well, I mean, that's a no-brainer, right? That's very, very simple. You're not going to be able to afford this policy. And here's why, Miss Mary. Let me show you in this policy how it works. Let me draw. This is literally what I draw for clients because we have to keep it basic, right? We have to keep it really, really simple for our clients. We don't want it to be complex. The more complex it is, the more confused they are, the less that they'll buy. And no one's explaining this to them when they're getting a universal life policy initially because it would confuse the heck out of them, right? They just wouldn't purchase it. Like, I have no idea what you're saying, right? And some of you might be like that on this call right now. You might be like, I don't know. This doesn't make any sense to me. If it don't make sense to you, it definitely don't make sense to clients, right? So, or I'm doing a poor job of explaining it. But more than likely, it's not going to make sense to the clients if it don't make sense to you. So that's why it's such an easy pivot to change to a whole life policy most of the time. Sometimes you find good ones and you got to be honest with the client and just tell them. But let's go into what does the policy say on it? So when you see a universal life policy, how do I know that it's a universal life policy? I know that it's a universal life policy because it'll generally say flexible premium. Okay, so on the policy, it's going to say flexible premium or something to that effect on there. What does flexible mean, right? It's you can bend it around, it moves, it changes. We don't want a premium that is flexible. I don't want a flexible premium. I want a set premium that doesn't change. I want it to be fixed. Miss Mary, do you want something that's like all your other bills that goes up in price when you get older? Or do you want something that's guaranteed? That is absolutely guaranteed. No matter how old you get or how sick you get, the price doesn't go up. The amount of insurance you have doesn't go down, and it lasts your whole life, right? Which would you rather prefer? Something that's flexible, meaning that you can bend it, you can change it, the premium changes, flexible premium, or would you rather something that lasts your whole life, right? Stays the same. And that's kind of a no-brainer for a lot of our clients. So for them, they look at it and they're like, hey, absolutely, I'd rather something that stays the same. That's a fixed rate. They're 65 years old. Well, the guy that sold me this 30 years ago told me I could use this for my retirement money. Well, that's great. And I wish that that was the truth. But back in 1991, 1990, in that time frame, we had different interest rate environment. And when they forecasted these products, they forecasted them based on higher interest rates. And unfortunately, you couldn't maintain a 10% interest rate when interest rate environments were just at 2.75%, right? So they were losing money on these policies. And what happens, Miss Mary, is most of them, they implode on themselves. But don't worry, that's not a problem, right? What I'll do is I'm going to show you a solution, right? So we sell solutions. Now, whenever we're looking at, and yes, to answer, because someone's going to ask a question, well, what about a guaranteed universal life? Yes, there's a GUL, guaranteed universal life, that does exist. That is a product that exists. You don't have any cash value inside it, and it's guaranteed to last your whole life as long as you make the premium payments. But why is universal life attractive just in general, right? Well, it's attractive for multiple reasons. If you design it properly, it can last your whole life, and you can take money out of it that's tax-free. That sounds pretty cool. Like, how does that work? So these are IULs, Index Universal Life Policies. So with Nationwide, they have a really good product. Prudential, those carriers, they have really good products. Nationwide is just one that I like personally. They have a really good product on their IUL. And what it does is you can look at it. I can say at my age, I'm in very good health, right? I look at it and I say, hey, I want to take out a universal life policy, and I want to be able to take out $15,000 a year when I turn 65. Okay, well, I'm 30, I'm going to be 31 in a couple months. Okay, so they say to me, okay, that's great. So what we can do is we can get you $100,000 life insurance policy. Okay, and if you die, it pays 100 grand. Perfect. Okay, great. So it's a life insurance policy, right? Yes, it is. But here's a little caveat for you. You can take money out of it tax-free. As you get older, you can start to take tax-free distributions. Life insurance isn't taxable. When you die, the government can't dip their hands in that purse and take it out, right? Yeah, you got to pay a state tax when someone passes away, but rich people use life insurance. That's why rich people do it. I'm going to stick with what rich people do. So what I do is I go ahead and I design this. Remember, it was $100 for $100,000 of life insurance. They say to me, Nationwide will say to you, hey, if you pay $250 a month, you're overfunding this universal life policy by $150 a month. You pay $250, the premium's $100 for the 100 grand. Now you're overfunding it by $150. When you overfund the universal life, your cash value grows like crazy. And the cost of insurance is not going to be offset for many, many years down the line. You're going to pass away before the cost of insurance will be offset. And here's the cool news. Now you can be able to take out so much money from this policy, right? You could take out so much money from this policy that you can use that money to actually maintain and pay the premium payments, because you got to pay the premium payments your whole life. If you don't pay the premium payments, the IRS are going to get mad at you, right? We call that a MEC, M-E-C, Modified Endowment Contract, right? That's a MEC. You got to make sure you pay those premium payments your whole life. So with our clients, most of the time, if we do catch them and the policy is not a good policy, and we catch them where they're on like this downward spiral at the end over here, right? They're at the end and it's like the cash value is decreasing. Let's say we catch them like right here, right? On this portion of it, and their cash value is just decreasing, and boom, they got like 15, 20 grand left. But we look at like the cost of insurance. We start doing the math. We're like, this doesn't look good. We can take that 15, 20 grand, whatever it is, and we can put it in a single premium whole life, right? We could take that money and put it into an annuity. An annuity is the safest product that you can be in right now. Hey, Ms. Mary, let me ask you a question. One, has your bills ever gone up or down in your life? Have they ever gone down? Nope, they've never gone down. Okay, great. Let me ask you another question, Ms. Mary. Right now, the price of gas, okay? The price of gas right now, is it higher than it was 2 years ago? Yes, it is. Okay, how much higher would you say that is? Well, it's about 300% higher. It's tripled, right? Okay, 300% higher. What's your favorite food? You like steak? Great. I like steak too. In order to get that steak to your grocery store, right? You get it to Costco, Walmart, Kroger, whatever you got to get to your grocery store, they got to use a truck a truck fills up on gas, right? Okay. Since the truck fills up on gas and gas prices go up, the cost of every single thing across that supply chain from the feed that the farmers use to feed the cattle, and then bringing the cattle to the butcher, and then the butcher's going to go ahead and chop up the meat, and then they're going to go ahead and put the carcasses in a truck. They take the carcasses, put it in a truck, then they bring it to whatever location that they're bringing it to. They bring it to Costco. Then Costco's got employees that they got to use that cut up all the meat, the butchers, and all that jazz, right? So the supply chain, the cost of everything has gone up. Since the cost of everything has gone up, Miss Mary, what we see is a lot of uncertainty. And now in this point in time, people want more certainty now than ever. So what we're seeing in your policy, Miss Mary, is that your cash value is decreasing. Okay. Once your cash value goes to zero, your premium is going to go up. And let me ask you a question, Miss Mary. You're on a fixed income, right? Okay. Since you're on a fixed income, Miss Mary, we want to have your bills stay the same as best we can. And the reason why you got this life insurance, and I might be wrong, but the reason why you got this life insurance is because there's two burdens when you pass away. Okay. There's the emotional burden, which I can't help with. I can't help with the emotional burden. Can't. And I'm sorry about that. I wish I could, but we all grieve in different ways. When my grandmother passed away, I was grieving different than my mother, than my uncles, right? Than my cousins. I can't help you with that. We all grieve differently. You probably agree, right? Okay. Now, the second burden is the financial burden. And I can definitely help with that. That's literally my job, right? Is I want to make sure when you pass away that your family's not stuck with any bills. And what we have here right now is something that you could potentially be stuck with bills. Okay. So that's the downside to what we currently have right now. So what we want to do here, Miss Mary, is we can look at different options. Okay. Now, what makes sense to most people is looking at something that we call permanent coverage. Okay. And with the permanent coverage that we have here, and then you go through the whole pitch, right? It lasts your whole life. The amount you pay per month never goes up. The amount of insurance you have never goes down, right? No matter how old you get or how sick you get, policy doesn't cancel as long as you pay your premiums. And the good news is, since you got about $10,000 or $15,000 here in cash value, we got a couple options. Okay. Option one, you can take the cash, right? That's your money. It's up to you. Option two, right? We take that money and we do a 1035 exchange for you agents. We 1035 it, right? So it's not a taxable event. And then we put that into a single premium whole life. It's pretty cool. That's a pretty good idea too. Now we're making money on both sides. Single premium whole life, and then maybe we sell them a life insurance policy too. And single premium whole lives is a different call for a different day, but they are pretty dang good when it comes to solving a problem like this. You could take the money, you dump it in to a life insurance policy, you make one premium payment, and that's it. So that's the way that I pitch a universal life policy and the way that they work. And what I want to do is, Will, I'm asking to unmute you because you ran into this, and that's the reason why I like doing this call. Will Montgomery, I want to unmute you real quick, and let's go over the scenario that you have. Will, can you hear me all right?
I can hear you just fine.
All right, you're the man. So let me go ahead and bring my camera back up over here. So, all right, so Will, so you ran into a variable universal life policy in the home when you were with the husband and wife combo, right?
Yeah, that's one of the ones I run into. I run into these universal as well.
Okay, so you run into the IULs, Index Universal Life, and a VUL. And a VUL, just so everyone knows, that's a variable universal life where you actually have to have a securities license to sell it. It's variable, changes, so it's a little different. And Will, you've got many years of selling universal life policies. And back in when you were selling some of them a while back, they were better quality products, and they've changed dramatically over the years, right?
Yeah. Well, I don't know if that is true or not, because actually, I started out selling whole life, and when they did switch over to these, I was securities licensed, and when they did switch over to the variable appreciable life, as far as Prudential, that's where I was, and the IULs, that is what really I lost my taste for those products at the time when I realized, I mean, you really left no meat on the bone with your explanation. You put it all out there, especially when you talk about the premium increases internally on that policy and the way they eat up the cash value of a contract.
Yeah, no, I completely agree. And the case, can you walk us through it real quick? The case that you ran into, which was a VUL, and I know we did a different explanation, and we can explain that. But so you ran into a husband and wife combo, right? And they had variable universal life policies, and they were kind of confused by it too, right?
They're totally confused. We stay that way because we requested information from Prudential in the form of illustrations, and Prudential didn't send what we asked for. So we're still in the middle of that one. And if you don't mind, I'd rather go to a case. It's a IUL.
Yes.
That's a lot, you know, that I've resolved and how we came out. I got a couple of them here that we resolved. In fact,
Definitely.
I carry them in my kit. So when I run into this, I can show people actual examples of people who had these policies and how they usually end up. Because to be honest with you, this was 30 years ago when you mentioned 1990s and whatever, when these policies started, and no one really knew what they would do because, like you correctly said, the interest rate was a lot higher then, and we did projections from then, but I knew that those projections wouldn't hold up over a full 30 years, you know, without dips or whatever. So if you want, I'll go over that right quick.
Yes, but you made one really good point first. Is when we're calling these, because you do this all the time. You like sometimes you and I, we say things, and all agents do this. We just say things that we go through our process subconsciously that like other agents might not even know. So you and I, we do this all the time. We call the insurance company. And when we call the insurance company, we ask for an illustration. If the policy doesn't have it, we need to see, hey, Miss Mary, how long is this policy going to last for when we're on the phone with them? And we got to explain to the client how long this is going to last for, right? So sometimes we have to go back to the house once they get the paperwork, and then we can actually look at it and tell them if it's good or bad, because we don't know all the time, or they don't have a policy. And this is something we actually do need to look at, because term is simple and whole life is simple. So yeah, we call them. And when you call the insurance company, what do you ask for when you're on the phone with them and then go into the policies?
You know, calling the insurance company or having an illustration, it sells this, it makes the sale for you. So whenever I see a universal life policy, I'm anxious to get the insurance company on the phone, because what I ask them, you know, of course, is, you know, the general stuff. I ask them, what is the insurance amount? Who's insured? Who's the beneficiary? Just stuff to throw them off a little bit. But then I get to the meat of it, where I ask them, how long will this policy last? You know,
yes.
I ask them how much cash value is in it now. I sometimes, in a universal life case, I will ask them how much was in there last year, because a lot of times what you'll see is a trend that it was more money in it last year than this year. Okay, well, now you need to explain to me why that is.
Yeah.
You know? And so what's happening is just what you just explained. The premium is increasing internally, and it's eating up the cash value. And the sooner you can recognize that 0 point, like you had in your illustration, I mean, the better you can save these people, you know? I mean, the better you can demonstrate that.
Absolutely. And the illustration comes directly from the company. And this, the biggest thing that I always say to clients, or while I'm on the phone rather, with the, and guys, keep in mind too, this is a customer service rep that's getting paid an hourly rate. They're not insurance agents, so they're not as well versed as us.
Exactly.
So you got to guide them, right? We always guide them with the right questions. Is that right?
Exactly, because they can never tell you what the reduced paid up is. They always have to get an agent. That's one thing they never tell me anyway. I believe I shouldn't say never, but I've never had.
Yeah, sometimes. But they will. But when you act, because you actually had a really good point with one of the questions that you were saying. How long is this guaranteed to last? And is this guaranteed to last Miss Mary's whole life? Like hypothetically, if Miss Mary lived to, because you ran into a lady today, I think, you know, when you call me, I think someone passed away at like 98 years old in her family.
Exactly.
Yeah. I mean, that's like, is it guaranteed to last her whole life? Is a very simple question. Term, the answer is, you know, it's black and white. No, you know, universal life, they might have been sold on the pitch that it's going to be there when they pass away. But when you call the insurance company, it's like, hey, is this guaranteed to last their whole life? No. And more than likely it's because it's not being overfunded and it's not taken care of properly. And if you do this, if you just pay what's called a minimum payment on a universal life policy, because they give you different options for premiums, right? Here's the premium to sustain it till age 95. Here's the premium, right? So they give you an example. here's the premium to sustain it for only 10 years. If you pay what's called the minimum premium payment on these policies, they become a 10-year term policy.
That's exactly right.
So you got to pay attention to stuff like that because, and of course, that's the whole reason why we do these calls. But Will, I'm sorry. Yeah, go ahead and walk us through a case example.
Okay, and I'll be real brief with that. I was seeing a guy about Medicare. He's 80 years old. The guy, him and his wife, was about 67. After I finished up the Medicare part, I just asked him, what was he doing for, a final expense. And he told me it had $100,000 policy, and we didn't have time. So he gave me that. I came, we set an appointment, but I went home and looked at it. I only had to look at this for a second. I mean, you would think a guy tells you he's 80 years old, you wonder about his health. He tells you he's got $100,000, you don't believe it really. So he gives you the policies and they're with a reputable company. He's with Allstate. I don't know if I can say that. I should be saying
Yeah,
that,
it doesn't matter. Yeah.
Allstate, it was a Lincoln Benefit Life. And he actually had two policies, $50,000 each. To go really fast, an agent, when you open that policy up, the first thing you see is 4 years of cash value in decline. Wow. In the 5th year, it goes to 0. And then you see 3 asterisks. And you follow that down to the bottom of the page where it tells you this coverage has expired without value. That's what the asterisks say. That's on one of the policies. The other one's a universal life. And he had $9,256 in it at the time. Had been paying on it since he's in his 60s. In 4 years, you watch the cash value go from 9,200 down to 0. And at the bottom right in black and white, it says under guaranteed values, which is the point you just made. If you pay that minimum premium, the guaranteed values provides coverage until age 83. So, yep. I mean, I ended up saving this guy $15,000 because we drew that out. We drew the remainder out. He was paying $400 some premium, which bought him a $20,000 whole life policy. So I left there pretty much a hero. I mean,
yeah, they love you.
4 or 5 appointments to get them to really, resonate with the fact that I can't help it that you paid into this for 20 years, but you have to think of it this way. It would have paid $100,000, and it still will for the next 4 or 5 years pay $100,000. But after that, you're 80 now, and you're in good enough health to get a policy. And because he qualified full underwriting. We went through Guardian.
Wow. Yeah. So you got him a really good quality product overall.
Yeah.
Yeah. So that's a major change actually. So let's kind of unpack some of those things there that you said. One thing that's a very important part that this is an objection that we overcome before we even show them anything in terms of price, because the reality is, and we got to tell them this all the time. The reality is, Ms. Mary, you're going to have less insurance with a whole life policy than you will with a universal life policy, like a quasi-term policy, right? It may terminate on you. So that's something that's a hurdle that you're going to run into, right? And you can kind of think of it, guys, as the AARP increasing term policy, right? So similar philosophy, okay? It's an increasing term policy, then at a certain point it ends. It ends at age 80, let's say, for example. But if they look at it on paper, it's $25,000 for $50 with AARP increasing term policy, but then with Transamerica, that same 25,000, right, is $100. It's like, well, where's the value? What am I missing here? So you have to do a really good job of explaining this stuff to the clients that, hey, I want to sell you certainty, and I want to sell you a solution. That's what we need to be doing as agents, right? The bigger the solution, I sent this out in an email today, the bigger the solution that you solve for a client, the bigger the commission check. It's a byproduct of this business. And the more referrals that you get, and it's this compounding effect. Because, Will, if this guy had a brother that got this policy, he probably would have said, hey, call my brother. He's got the same exact thing. Walk up, and then he would do the sale to his brother for you, and you go to his brother's house and you lock it down.
True that.
So that's a really, really good example. And the best thing, Will, you and I say this all the time when you're with the client, numbers don't lie, right? It says it in black and white right here. Policy expires without value.
That's right.
There's no value in it. What is value? Nothing, zero, zip, zilch, whatever you want to call it. It's nothing. There's no value to the policy. And you made a really good point too. it will pay. If you died 10 years ago, it would have paid 100,000, right? If you died 20 years ago, you had this since the 90s, 20 years ago, it would have paid 100,000. If you died last year, it would have paid $100,000. You're in such good health, you could outlive this policy. And the downside is you outlive this policy. The whole reason you got it is for it to pay, right? Now you're going to end up with nothing because your cost of insurance is going up. We go back to that $510. Premium is going to be so high, you're just going to end up canceling it. So we might as well just lock something in that's permanent. Does that make sense? It does. Boom. And then they're locked in, right? They're in agreement with you the whole entire way. Will, so what else should we add to that? Was there anything else you wanted to add, or did you have another case?
Well, I do have another case.
Sure, go ahead.
A young lady, same situation. And I mean, I have two of her illustrations that I carry with me as well to show people. And she had a $35,000 policy, paying the minimum premium, which is what is really an attraction that these people have, is because universal life is usually a little bit less because it's actually term insurance, you know, and so if you choose to pay a higher premium, you know, that's what builds your cash value, as you pointed out. So I mean, looking at this policy from November 2016 to November 2017, she had $6,600 in the policy. And
Wow.
then when I looked at the next year that she gave me, from November 2018 to 2019, she had $5,500 in the policy. And so I was just able to show her how it's declining. She's not as in bad a shape as the other guy. This policy will last quite a while, yeah, before it expires, but it will expire at some point, because as she gets older, she's 60 now. So I'd imagine by the time she's 80, she'll be in the same situation.
Yes. Yeah. And that's kind of the thing, is if we can get ahead of it and prevent this from occurring, because there's some really good universal life policies, but and Will, you were saying this before, there's some really bad ones out there where we just know the numbers don't add up. And if you look at it, went from 6,600 in 2018, what you were just saying for the cash value, down to 5,500. And that is about a 20% decrease. 1,100, $1,200 would have been a 20% decrease, right? Like in that ballpark, somewhere along those lines. So if you're talking a 15 to 20% decrease annually in cash value, that gets eaten up pretty quickly, right? And that's a very large number to go down, $1,100 year over year. And then sooner or later, you know, she's paying a very, very fat premium to maintain that policy. And that's what happens is, when they get to that point, they look at a lead card that they get in the mail, they take time to fill it out, they send it in, because the last time they did that, they got an insurance agent that came out to their house, sat down, talked to them. They didn't buy from them because they didn't believe them, right? Now they're at the point where they have to believe them because the insurance company sent them a letter saying, hey, your premium's going up next year to this. Another year goes by, hey, your premium's going up this year to this. And they're seniors that don't understand, people that they can just be confused, and they need help. And that's all that it is. And that's all our job to do, is to help them. And if we can get ahead of it before it becomes a major problem, like, you know, the prior case, then we want to do that by all means. But there's many times that I've gone into homes and I've sat down with clients and I see it and I'm just like, I'm so sorry to tell you this. Like, and I feel horrible on the inside, because they genuinely thought when they were sold this, that this is money that they could take out in retirement, right? Someone sold it, but they didn't overfund it properly, right? It's flexible premium. You can change your premium. If in the example I gave you guys for the $100,000 UL that I have, right? If I'm paying $250 a month, I'm overfunding it by $150, but I don't have to pay $250 a month. The base premium is $100. I can go down and I can turn into a 10-year term policy if I wanted to, right? So that's kind of the thing, is that the premium is flexible. Hey, they call the insurance company. I can't afford this. I don't know what to do. You know, I don't want it to cancel. Customer service reps on the phone. Oh, that's okay. You can just pay $100 a month instead of $250. Oh, really? Great. They start doing that and they never change it, right? Sure. And then boom, the policy just disappears on them and they don't know why, because they don't understand it. And that's okay. But that's why we're licensed professionals and we have a job, right? Not a job job, not a just over broke job. We make a lot of money in this business. So that is really, in a nutshell, it's a universal life policy, how they work. I don't want to go too in depth on variable universal life policies because they're so few and far between that we run into in the field. And the reason why I say that is because variable universal life, like I was saying, you got to be securities licensed in order to do it. I had a securities license. I let it lapse. I don't use it anymore. Will, I know you said that you had one too. It's not if a client that we're sitting down with has someone that is securities licensed that they work with, they're probably not a final expense client. And more than likely, they're probably an annuity candidate, more so than a final expense candidate. But of course, we'll try and sell them everything. We give you so many at bats when you're in the home: health insurance, life insurance, indemnity plans, annuities, traditional life products, in addition to all that. So give you a ton of options. Well, was there anything else that you wanted to add?
No, well, like I said before, I mean, you clean the bone on that subject. But you just brought up one thing I would like to say or ask a question. You brought up securities individuals. Okay, if you work for something like Edward Jones,
Yeah.
and you sold this variable appreciable life plan, which is a securities product, I mean, you're really not able to show an annuity or something as a replacement, is it? I know it's some products that they cannot show.
Oh, to compete against it? Yeah.
Exactly. So you're not going to get the full story. So when someone says they have a broker, they say that with a sense of pride, like, he knows everything, but he may know it, but he's not at liberty to share with you what I am.
And that's a really good point too. And guys, before we wrap this call up, I really want, if you guys have questions, please raise your hand, drop it in the group chat. Kimmy, you do have a question there. I'm going to answer that in just a second too, but I want to go back to Will's point. When we're sitting down with clients, we're not securities licensed. Are we going to pitch them on a 401k? No, we're not. Are we going to pitch them on opening up an IRA with us? Right. So a 401k, retirement account through a company, it's a retirement account. When they retire, they take that and they roll it over into an IRA. For us as insurance agents that aren't securities licensed, do you think we're going to pitch them rolling it over into an IRA through a brokerage house, like what Will was just saying, Edward Jones? Or do you think we're going to pitch them on using Athene or Prudential's nationwide annuity products? Right? We're going to pitch them on what we can sell them. So they're not getting the full story from that broker that they have. The broker is pitching them what they can pitch them. But we sell guaranteed. We sell certainty. Guaranteed that you can never lose money in an annuity. No matter what, you can never lose the principal that you put in, the $100,000, plus the interest that's accumulated at the 5% from the beginning. Year one, let's say you got 5%. Now you had 105 grand. Year two, it accumulates again. You get 10% that year. You made a killing, right? 105,000, boom, boom, boom. You can't lose your principal plus interest. Guaranteed. Call up your Edward Jones rep and ask him real quick, and he's going to know how to handle it because he's a salesperson, right? Call him up and ask him, hey, is this guaranteed that I'll never lose money? They can't say it. Otherwise, you can sue them, right? When the market collapses, get that on recording, or get it in writing, right? That you're guaranteed to never lose money. It ain't going to happen. They'll never, ever tell you that. I'm not guaranteed in my retirement accounts to never lose money. I got silver coins. Those are not guaranteed to even stay at the same price, and it's silver. Right? That's a silver coin. That's not guaranteed to stay at the same price. With an annuity, it's guaranteed you can never lose money. How do you like that, Miss Marion? They love it. But annuity is also a different call as well. So I took some notes here. So if you got questions, raise your hand. Will, thank you so much. I appreciate you as always. I'm going to go ahead and mute you back on up. Thank you, sir. And if you got questions, when you're on the phone, I think you can press *6. Could be wrong to unmute yourself, but let me go over Kimmy's question real quick to see if anyone else has any questions. I'm going to go over hers. So she said, is this how cash value works for a whole life final expense policy? And that's a great question, right? So the main thing over here that, let's go back to this illustration that I had over here. I'm going to go ahead and share screen 2. All right. So y'all should be able to see this over here now. All right. So on screen 2 here, not screen 2, it doesn't matter. I have 2 monitors, so that's why I'm saying screen 2. So premium payment on the left-hand side, and in the center column over here is cost of insurance, only with a universal life policy. Do you know what happens with a regular whole life policy? Delete, right? Go ahead and you can delete that column. Okay, that's gone. Okay, and what happens is in year one, if you're paying $250 a month, you're going to have cash value that's either accumulating in year 2, probably like 18 to 24 months, it's going to start accumulating. So let's say, for example, in a whole life policy, it was this number times, let's say is 0.15 times 15%, right? So what we can do is that the cash value is going to grow and accumulate, right? At that amount, it's going to go up annually. It's going to increase. So that's what we'll see inside of a whole life policy. It's just premium and cash value. That's it, right? There's no cost of insurance, confusing stuff that clients end up canceling a policy because it's confusing with universal life. So that will do it. If you got any questions, please go ahead and raise your hand real quick. If not, I will let y'all get back to your evening. Google universal life policy, go to Investopedia, read about it, look at it. This is recorded call. I will go ahead and send this out. I'll do it send it out on a YouTube link via email. If you don't have my email address, it is Holden, my first name, HOLDEN, at my website, which is finalexpensemastery.com. I'm typing it in the group chat at the same time. My first name, Holden, HOLDEN, at finalexpensemastery.com. ETE, you're a legend. Love you, dude. You're the man. Appreciate everyone for hopping on. If y'all need anything, just give me a holler anytime. Appreciate you guys. Bye.